Good evening, students. Today's Premier Academy LMR question for intermediate. Financial leverage is a double-edged sword. Why? We have to explain with respect to financial leverage. Financial leverage arises only if there is a financial commitment, nothing but borrowed fund. Whenever loan funds are there, financial leverage will arise. You know, three types of leverage analysis in leverage analysis: operating leverage, financial leverage, and combined leverage. Formula for financial leverage is DOL is equal to contribution divided by EBIT in case of degree of operating leverage. DFL is equal to EBIT divided by EBT. So earnings before interest and tax divided by earnings before tax is a degree of financial leverage. Now, with respect to financial leverage, the EBIT and EBT, in between what is there? Interest portion. Therefore, when the interest portion will come, only if you are going to borrow the loan. Therefore, the degree of financial leverage arises only in case of debt fund or borrowed fund. Now, it's a double-edged sword. Why it is called a double-edged sword? One hand it's a benefit, another hand it's a risk. That's why it's called a double-edged sword. Or benefit is there and or loss also. One loss is also there. If I am going to borrow the fund, when I can be in the position to borrow the fund? Only if there is a benefit out of the fund. I want to invest the fund out of which I am going to get the return out of the fund. The return should be higher than the cost of the debt. Then it is viable. For that, you should be in the position to know characteristics of source of fund. What all the characters are there? Risk, cost, and control. It's a frequently asked question, basic concept, characteristics of source of fund in financial management. There are three characters: risk, cost, and control. With respect to cost angle, between own fund and borrowed fund, which one is costly? Cost represent what? In case of own fund, payment of dividend is the cost. In case of borrowed fund, payment of interest is the cost. Therefore, own fund, borrowed fund, cost represent dividend and interest. Between two, which one is costly in company's point of view? Dividend is costlier than, payment of dividend is costlier than payment of borrowed fund interest. Why? There are two main reasons. Dividend expectation of the shareholders are always higher than interest expectation of the loan holder. Dividend means there is no tax benefit, whereas interest we are having tax benefits. So, interest, whether I am having profit or not, I have to pay, but payment of interest is fixed in nature. Whereas dividend, based on the profit, I have to pay dividend. Therefore, payment of dividend always costlier. At the same time, interest if I paid, I can be the person to debit in the P&L account. If I am going to debit in the P&L account, profit will come down. If profit is going to come down, I have to pay less tax. But in case of dividend, even if I am going to pay the dividend, I can't afford to debit as a expenses in the P&L account. Therefore, I am paying tax, thereafter only I am paying dividend. Therefore, double the normal cash outflow. Therefore, payment of dividend always costlier than payment of interest. Now, come back to our leverage analysis concept with respect to based on cost. When I can be the person to borrow the fund? If I am going to borrow the fund, the borrowed fund is cheaper in company's point of view. For example, I am going to pay 15% interest on loan, borrowed fund. When I am going to borrow, after investing the fund, I am going to get more than 15%, then only beneficial. I have to invest the fund in the business. For example, I purchased the loan, I am paying interest on loan 15%, and I am investing the loan, I am investing the money in my business, I am getting 20% return out of the business, then 5% extra leverage is there, benefit is there. Therefore, I may be in the position to borrow the fund only if cost of debt KD should be lesser than our return out of the business, return on capital employed. So, return on capital employed should be higher than cost of the debt, then only you can borrow the fund. So, I am going to get the benefit out of borrowed fund, and I am going to enjoy the benefit of tax benefit. Therefore, this is from the positive angle. Therefore, we can borrow the fund. Accordingly, we can be the person to invest the business and earn the profit. At the same time, if I am going to borrow the fund, if I am not in the position to earn the profit, what will happen? Go back to again source of fund, characteristics of source of fund. How many characters I said? 3 characters. What are all them? Risk, cost and control. With respect to risk factor, which one is high risk? Own fund or borrowed fund? Borrowed fund is risky. Remember one thing, risk, cost, control. Cost wise, cheaper is borrowed fund, whereas risk wise high. Risk represent what? Risk with respect to repayment of the loan amount. Repayment. When the risk will be high, in case of own fund, I no need to repay immediately, shareholders fund. But in case of borrowed fund, after a particular point of time, I have to repay. If I am not going to repay, then they can file the case. If they are going to compel them to make the money, get back the money, we have to give that money. Then we have to sell it off on land and building, plant and machinery. Then only I can be the person to settle if I am not having adequate profit. Then going concern may going to get affected. Therefore, risk wise very high. Therefore, one hand I am getting the benefit out of the borrowed fund. Another hand I am getting the risk out of the borrowed fund. Therefore, financial leverage is a double-edged sword. It's an expected question, frequently asked question also. Hope you understood. Bye.